What if I told you you don't need to memorize complex candlestick patterns like hammers or dojis to predict the market? Instead of scanning for engulfing candles or shooting stars, you could simply look at the last two candles and instantly understand the market sentiment in real time. Don't get me wrong, classic candlestick patterns are useful, but let's be honest, they often fail. A hammer at a support level? Failed. A big green candle at a breakout? Failed again. I thought I had candlesticks figured out until they failed me over and over again. And then everything changed. A few months ago, I came across a book by Lance Beggs titled YTC Price Action Trader. Inside this book was a section on the two-candle theory. It completely changed the way I read candles. No more guessing. No more relying on patterns that might work sometimes. With just two candles, I could see whether the market was bullish, bearish, or sideways. In the next few minutes, I will show you exactly how this works. First, we'll break down the basics of the two-candle theory. Then, we'll analyze a real-time chart to see it in action. And finally, I'll show you how to create trade ideas based on this theory. If you've ever felt like you were chasing the market, this is the video you cannot afford to miss. The two-candle theory is not just a set of candlestick patterns, it's more of a process. When it comes to the standard candlestick patterns, we memorize the pattern and wait for the price chart to create the candlestick pattern. When it does, we trade based on that pattern. We simply ignore the rest of the candles. Don't you think that's a bit odd? How can we ignore all other candles like they're all irrelevant? This is where the two-candle theory is different. Under this theory, we perform an initial assessment to identify the market bias, bullish, bearish, or sideways. Then, with the formation of each subsequent candle, we see if that candle supports or contradicts our bias. For instance, let's say we had a bullish bias from the start of this candle. With each candle's formation, we see whether the bias is supported or not. During this pullback, we had three candles that indicated that the buyers were getting weak and the sellers were pushing in. The price then made a weak up move only to reverse and crash. This is the power of the two-candle theory. To use this theory, you need to understand two key concepts. Number 1, close position. Number 2, close comparison. The close position allows us to identify the strength of the bullishness or bearishness of one single candle. To determine the close position of a candle, we divide the high-low range of the candle into 3 equal parts. Then we see if the close of the candle is in the upper, mid, or lower third. A high close candle is a candle whose closing price is within the upper third of the candle range. Here are 6 candles that are all high close candles. All of these candles represent a bullish sentiment for the period of the candle. However, the degree of bullishness on each of these candles is different. For example, if we compare candles 1 and 2, we can see that candle 2 opened near the low of the range and closed at the high of the range. This shows that the bears showed very little to no resistance at all. The bulls were quickly able to overcome the bears. However, with candle 1, the price initially fell from the open before reversing and closing near the highs again. The bears were in control initially, but the bulls got active and closed near the high again. With this understanding, we can clearly see that candle 2 is more bullish than candle 1. Then, we have the mid-close candles. A mid-close candle is a candle with the closing price in the middle third of the candle range. Mid-close candles are considered neutral because the price moved above and below before closing somewhere in the middle. All of these candles are mid-close candles. However, the neutralness differs for each of these candles. Candle 3 is a mid-close candle with a slightly bullish bias, while candle 6 has a slightly bearish bias. Lastly, we have the low-close candles. These are candles where the price closes in the lower third of the candle range. Low-close candles are considered to show a bearish sentiment. All of these candles are low close candles, but their bearishness differs from one another. For instance, candle 1 signals that the price initially went up to create this high, then the sellers came in to close the candle in red. However, if we look at candle 3, the price opened up and the sellers were immediately able to lower the prices and continued to do so until the price closed near its low. By understanding the meaning behind these candles, we can clearly see that candle 3 is more bearish than candle 1. Using the candle's close position, you can identify that particular candle's sentiment. Now let's improve the sentiment analysis by comparing the close of the current candle with the previous candle's range. Using the close comparison concept, a candle can be a bull candle, a range candle, or a bear candle. A bull candle is a candle where the current candle's close is above the previous candle's high. In other words, the close of the candle is above the previous candle range. It shows that buyers are trying to push the price up. It indicates a bullish sentiment. A bear candle is when the current candle's close is below the previous candle's low. In other words, the close is below the previous candle range. It shows that the sellers are actively trying to lower the prices. Therefore, it indicates bearishness. A range candle is where the current candle's close is inside the previous candle's range. It indicates that the buyers and sellers are struggling to get a hold of the market. They are closely matching each other in the fight. Therefore, it indicates a ranging or sideways market condition. Now that we have understood both of these concepts, we will combine them to create a process to analyze the market sentiment for each candle. This is the two-candle theory in action. To do so, I have created this table. We have created 3 rows on the x-axis for the close comparison: bull candles, range candles, and bear candles. On the y-axis, we have created 3 columns for the close position: high close, mid close, and low close. Using these concepts, there are 9 possible candlestick patterns. Let's cover each in detail. Number 1. High close bull candle. This is the most bullish pattern among all these candles. A high close bull candle means a candle where the close is above the previous candle's range and in the top third of the current range. It shows that there is a bullish sentiment in the market and the strength of the buyers is extremely strong. They are overcoming every sell order and closing near the highs. Number 2. Mid-close bull candle. For this pattern, we have a candle where its close is above the previous candle's range and in the middle third of the current range. This shows that there is a bullish sentiment to the market, but the strength of the buyers has been reduced a little as there are sellers that have taken the price down from this high to close the candle within the middle of its range. The sentiment is still bullish, but the bullishness is not as strong as that of the high close bull candle. Number 3. Low close bull candle. This is where the close of the candle is above the previous candle's range but in the lower third of the current range. This shows a bullish sentiment in the market, but the strength of the buyers has been reduced significantly, as sellers have taken the price down from this high to close the candle near its lows. The sentiment is still bullish, but the bullishness is extremely weak. Number 4. High close range candle. For this candle, we have a candle that closed inside the range of the previous candle and in the upper third of the current range. This shows that the sentiment is sideways, but there is a slight bullish momentum in the short term. The current candle shows that the buyers were able to overcome the sellers and close near the highs, thus indicating a slight bullishness in the overall neutral sentiment. Number 5. Mid-close range candle. This is the most neutral candlestick among these patterns. This pattern can be identified by a candle that closes inside the previous candle range and in the middle third of its current range. It indicates that there is an intense fight between buyers and sellers. Both sides are well balanced as the price closes near the midpoint of the range. Number 6. Low close range candle. As the name suggests, it's a pattern where the current candle close is inside the previous candle range, but the close is in the lower third of its current range. It indicates that although the market is neutral, the sellers have a slight upper hand. This is because the sellers were able to push the prices down and close near its lows. It indicates a slight bearish bias among a neutral market sentiment. Number 7. High close bear candle. For this pattern, we have a candle where the close is below the previous candle range, but in the upper third of its range. It shows a bearish bias, but the buyers are stepping in as they move the price from its lows to close the candle near the highs. The sentiment is still bearish, but it is weak. Number 8. Mid-close bear candle. This pattern can be identified by a close that is below the previous candle range, but in the middle third of its current range. It shows that the sellers are considerably stronger than the buyers, but the buyers are present and have pushed the prices up from the low to close near the middle. It indicates a bearish bias with a mild weakness. Number 9. Low close bear candle. This is the most bearish pattern. It can be identified by a candle that closes below the previous candle range and in the lower third of the current candle range. This indicates that there is a bearish sentiment in the market, and it is really powerful. The sellers are overcoming every buy order to close the prices near its lows. So, these are the 9 candlestick patterns. You don't need to memorize them at all. Once you start using them, it will become easy. As I said earlier, you need to practice this in live markets. After every candle closes, you will identify it and take that into context. In the next section of this video, we will look at the real-time analysis of a chart. It will help you understand the process and how it relates to the context. This is a 5-minute chart of the S&P 500 index. This is the first candle of the day, so let's start our analysis from here. We will ignore the first candle as our analysis is based on 2 candles. We simply wait for the next one. Next, we have a high close range candle. It indicates that even though the price has gone down, buyers have come in from these lows to close here. So, there are buyers who are present at these lower prices. Next, we have a low close range candle. It seems like sellers are dominating the buyers, but since the last 2 candles were range candles, we have a neutral bias. Next, we have a high close range candle. It shows that the sellers were not able to create new lows after this candle. The buyers came in and quickly reversed the price upwards. However, we are still in a range though. The following candle is a low close range candle. The sellers that pushed the price before are still present. They got in around these highs to close the prices lower. At this point, we can see that the buyers and sellers are at a tug of war. We are still in a range. Buyers are present down here and sellers present up here, the price is in the middle creating a neutral sentiment. Next, we have a low close bear candle. For the first time on this particular day, we have a bear candle. It shows that the sellers have dominated this candle and have managed to close the candle near its lows. If they are really strong, we should see a few bear candles after this. If we do see a few bear candles from this point, we will switch our bias to bearish. However, that does not happen. Instead, we see a high close bull candle. This candle gives a strong bullish indication. It indicates that the buyers stepped in and took the prices higher and closed near those highs. This is followed by another high close bull candle. For the first time, we see a follow-through after a strong candle. It indicates that the buyers are not messing around. They are here to stay, at least in the short term. At this point, we switch our bias to bullish. The next candle is a mid-close range candle. It indicates a slight pause in the trend, but nothing serious. Next, we have a high close bull candle. This aligns with our bias, so we move forward. Next, we have a low close range candle. This indicates that the sellers have now entered at these high prices and they have pushed the price down to the open. It's a small sign of caution. We may see a small pause or a pullback. The following candle is a high close range candle. In this context, it indicates that the buyers stepped in at these lower prices and moved the price upwards. The sellers that were present in the previous candle were not able to close the price lower. The buyers did a great job of recovery. Next, we see a small mid-close range candle. It indicates that the buyers and sellers are in a tug of war. If we were to see a few more candles like this, we could say that the price has gone into a sideways range. However, the next candle is a big, high-close bull candle. The buyers finally stepped in and took the price higher. We might see another up move here. The next candle is a mid-close bull candle. This is a sign of weakness. The previous candle showed that the buyers had gained control and were running with the price. That should have continued if the buyers were genuine. Why did the buyers fail to move this price higher? The sentiment is still bullish, but we are on alert. The next candle is a low close bear candle. This is the strongest possible bear candle. The price is starting to crack and the sellers are entering the markets now. It could just be a pullback in the trend, but still, it counts for something. The uptrend is not as strong as it was before. We have another low close bear candle after this. It's a strong sign that the sellers do have follow-through. At this point, there is a strong possibility of a shift in the sentiment. The next candle, however, shows the buyer's interest. It's a high close range candle. This shows that the buyers have reacted strongly to this down move. They are buying at these low prices. It's a sign of a fight back. Next, we have a mid-close bull candle. It shows that the buyers are in control, but the sellers are also pushing. It shows that there is a fight among buyers and sellers. We are possibly in a short-term sideways range. At this point, our sentiment has turned neutral. The next candle is a high close bull candle. It's a strong, bullish candle that shows that the buyers are pushing and gaining control. If the price gives an upward follow-through, it will indicate that the pause here was just a pullback and the trend will continue. However, the next candle is a low close range candle. It shows that the sellers are still present at these high levels and they are trying their best to take the price lower. Next, we have a mid-close range candle. It is in line with our original neutral bias, so there is no need for an explanation. The next few candles are all mid-close candles that confirm our bias further. However, this candle is a low-close bear candle. It indicates a bearish sentiment, at least in the short term. It is followed by two more low-close bear candles. At this point, we can confirm that the price is in a downtrend and the bias is bearish. So we expect a down move. And that's what happens for the rest of the day. I hope this example has helped you understand how to analyze the candles using the two-candle theory. Now, let's combine this knowledge with support and resistance to create some trade ideas. On this chart, we start our analysis from this candle. It is a high close range candle. This means we are currently in a sideways range with a mild bullish bias. If we look at the previous price, it seems to confirm that the price was moving in a sideways range. The next candle is a mid-close range candle. Again, this is confirmation that we are in a sideways range. Then we have a high close bull candle, a sudden change in the bias. This is the strongest candle that could possibly indicate the start of an up move. But we cannot simply buy here. We need to wait for the trend to develop first. The next candle is also a high close bull candle. Two of these strong patterns in a row. This means that the buyers have shown serious interest and are pushing the prices higher. Next, we have a low close range candle. It's a slight bearish candle with a neutral sentiment. Since the price has made this 5-candle move, it is obvious that there is a possibility of a pullback here. This pullback could be in the form of a range that forms for the next few candles. The candlestick pattern is also not too bearish, so our uptrend bias is still intact. The next candle adds confirmation to this bias. It is a high close range candle. The sellers dominated the previous candle, but the buyers stepped in and retook control. It seems that the sellers were unable to follow through. The buyers are jumping in at every opportunity. This is a strong signal that the buyers are going nowhere. Next, we have a low close bull candle. It's a bullish candle, but the sellers came in around the highs and pushed the price down. This analysis makes sense because we can see that previously, the price pushed down from the same area, so we can mark it as a resistance level. If our analysis is correct, we could see a strong breakout of this level in a few candles. If the breakouts happen and the candlesticks still indicate a bullish sentiment, we will look for a buy trade. But as of now, we wait. Just a reminder, the bias right now is still bullish. The next candle shows us that the buyers are still not ready to give up. It is a high close range candle, quite the opposite of the previous candle. This shows that the sellers tried to use this resistance to push the prices down. But the buyers saw these low prices and entered with strong urgency. In a short time, they were able to cover the distance and close. This is again a sign of bullishness. At this point, we are in a small range within an uptrend. Next, we have a high close bull candle. This is a strong bullish candle, and we might see an up move from this point. Notice how this strong candle has appeared at the breakout of this resistance level. It is a strong sign that the breakout should be successful, and the price will likely continue upwards. So we enter a buy trade at the close of this candle. We keep our stop loss below the low of the candle. We will keep the targets at a 1 to 1.5 risk-reward ratio. However, if the sentiment changes while we are in a trade, we will exit the trade. The next candle is a mid-close range candle. This indicates that there was no great follow-through after the breakout. We have already taken a buy trade, so this is a caution sign for us. But since it's a neutral pattern, there isn't much to worry about here. We can stay in the trade as of now. Next, we have a high close range candle. It seems like the buyers are still trying to push upwards. It's a good sign, but still we are in a range. Followed by that, we have a low close range candle. Again, this confirms that we are within a range and that the buyers are not in complete control. The sellers are fighting hard. Next, we have a low close bear candle. For the first time, we have a strong bearish candle. This is definitely a sign of worry, but if we look at the broader context, we can see that the price is right around the support level. If our bias is correct, then the next candle cannot be bearish. It has to be positive. But if we see a bearish candle next, it will be a sign that the sellers are following through and the support is being broken. At that point, we will exit our trade and change our bias from bullish to bearish. The next candle is a high close bull candle. The buyer stepped in and completely blew the sellers off the water. It is a sign that the buyers are still strong and the price may continue upward. So if you missed a buy trade at the breakout, you can buy here as well. As you can see, the price continued to move upward after our entries. Here is another example. Here we see that the price has been in a steady uptrend for a few hours. We can see a few high close bull candles throughout this uptrend. Most of the time, we saw follow-through after these candles. On the other hand, we see a few low close bear candles as well, but they did not have any follow-through. In fact, the markets actually reversed from these candles. This is also a sign of an uptrend. We are currently in a pullback and have started seeing a few high close bull candles again. This is a positive sign. However, there are warning signs here. During this pullback, we see that for the first time in this entire uptrend, we have a low close bear candle that leads to a follow-through. This means that sellers saw this as an opportunity to short. The trend is still up, but this is a warning sign that sellers are present in this price area. The latest candle is a mid-close bear candle. It indicates that the sellers came in and pushed the price down with urgency. However, the buyers were able to fight back and close the price somewhere in the middle. So the trend is upwards, but we are cautious. The next candle is a high close range candle, indicating that the buyers have gained control of this small one candle range. Following that, we have a high close bull candle. A strong bullish candle shows that the buyers have complete control now, and they are pushing the price upwards. However, the follow-through was not as strong as we hoped. We have a mid-close bull candle here. Still bullish, but as expected, the sellers tried to fight at these high levels again. The next candle is a high-close bull candle. This is a positive sign that the buyers have successfully absorbed the sellers and closed the price near its highs. However, we don't see a follow-through after this positive note. It's a sign that after absorbing all of these sell orders, the buyers do not have much fuel left. This is confirmed on this mid-close bull candle. The buyers tried to move the price higher, but the sellers were able to come in and close the prices down, another sign of exhaustion. The following three candles were all low close range candles, indicating that the price was in a range. The buyers tried to take the prices to these highs, but every time, the sellers were able to absorb their orders and close the price near its lows. At this point, even though we knew buyers were weak, we had not seen sellers getting any stronger, so there was no confirmation of a reversal. All we know is it could possibly be a neutral sentiment. Then, we see a low close bear candle. The candle was pretty big and it showed the urgency of the sellers. It's a first sign of strength from the sellers. However, we need to see a follow-through. The next candle is a high close range candle. The buyers tried to balance out the sellers here and showed some strength. But the very next candle was, again, a low close bear candle. This was followed by a follow-through. For the first time, we had seen a strong follow-through after a strong bearish candle. This showed that the trend had reversed and the sellers were now in control. If you notice, the price has already broken these support levels with ease. To take an entry, we wait for the price to break this support level. This low close bear candle breaks below the support level. It is a strong bearish candle. Therefore, we can take a sell trade here. We can keep a stop loss above the high and manage the trades actively. As you can see, the price has moved down. So that brings us to the end of this video. Remember, I don't want you to trust me blindly. Practice these concepts on your charts and develop your own trading style. The market is always teaching us something new, and the best traders are those who never stop learning. If you found value in this video, please hit that like button and subscribe to our channel so you never miss any of our new videos. Until next time, trade smart, manage your risk, and stay patient. Thanks for watching.